What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is April 10th of 2024. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to spend some time to not only talk about the failed breakout we had on Bitcoin's price against its line of resistance. I want to talk about what that's going to mean for Bitcoin's price going into the next couple of days and weeks. But beyond that as well, I want to spend some time to also talk about the broader picture around Bitcoin, talk about the altcoin cycle narrative and what the charts are showing us right now about whether or not that's possible. And beyond that as well, I want to spend some time to talk about the macro. I want to dive into a lot of interesting charts that I don't think people are covering that are going to give us an idea not only of what we can expect over the next couple of weeks and months, but also over the next year or so. We got a lot to unpack here in today's video, so if you happen to enjoy it, consider dropping a like. It's one of the greatest ways you guys can support the content we put out here on this channel. And let's go ahead and kick off the rambling. All right, guys. So I want to start here by talking a little bit about Bitcoin's failed breakout the other day. If we just kind of expand the chart here and dive into the daily price performance, this is a really great indication of why I emphasized the other day to wait essentially for a break above 75,000 to get confirmation of going long. You know, a lot of people in the market right now, and I know many of you might be doing this as well. It's okay. I respect everyone's decision, but a lot of people are trading with derivatives in the market. And we've constantly talked in this channel about leverage, trading on margin, and essentially derivatives and how that can be a major pain point for traders, because essentially they're trying to trade breakouts. They're using old kind of patterns of TA recognition. We've got a clear wedge that's been building up here. And obviously, a lot of people, when they see that break, want to go long and bet on a continuation in Bitcoin's price expansion. But the problem with that is that market makers, exchanges, the big boys, the market as a whole knows how to play against those kinds of emotions and expectations. And what do you know? We had an engulfing candle yesterday that ate up all of the gains from back on Monday. And now we're still just barely holding on this 21-day moving average, pretty much where we've been since back in early March for more than a month. Now, I want to make one thing very clear here, guys, that irrespective of what's happening in this cycle, this is very normal for Bitcoin following a retest of the all-time highs. I want to bring it here to the weekly chart and just kind of demonstrate this. We can see back, for example, when we revisited the 2017 highs in 2020, we had a couple weeks of stagnation here, pretty much a month's worth of price action before we really got those green candles where things really kick off. And we can see this as well in other previous cycles when we revisited the previous 2013 highs before the Mt. Gox collapse. Here, for example, in 2017, right? We had, in this case, not only a retest here of those prior highs, but we saw again another expansion, a failure to be able to really break above that range. And all overall, this was from January 2017 to April of 2017. So this can take some time before we really get that continuation, right? It's very normal for something like this to happen. The important thing that you need to be able to accept is that there might be, during that window of time, as we can see here on the charts, many retests of those longer term moving averages, like the 100-day or 200-day. Those are kind of your bottlenecks to know whether or not this is going to be a continuation for a broader move, or if this is really going to be the end of the party, the punch bowl spilled over, and the game's up, and we should be expecting a full swing bear market. The only problem here is that these moving averages are quite extended away from where current prices are. We've had a really nice rally here, even stronger than the one we had from October 2023 to January, leading up into that anticipation. And I want to go ahead and again emphasize that if you're looking for kind of that point where you as a trader could really just go long on a lot of names, you could bet on a much more likely scenario of an altcoin cycle. Again, I'm going to emphasize that 75K level, big even level here, $5,000 interval, and that would be well above an established new high versus the prior one back in March. But I want to more importantly talk about what's going on here right now in markets and why we could be stagnating here against the highs. Because I know a lot of people obviously say, Nick, you know, we have the halving event coming up in pretty much around a week now. It's crazy to think that 4-year event has come up yet again. We covered the last halving event here on the channel. And a lot of people are obviously excited about that. And a lot of people are also pointing, Nick, when you add in the ETF flows, when you add that in with the Bitcoin halving event, Bitcoin should just go supersonic, right? Well, as much as we here have talked about in this channel that when you get to the previous all-time highs, it is likely that it's going to continue. And we do have, again, two generally positive events here for crypto markets, the ETF and the Bitcoin halving event, continue to contract supply and increase the inflow of demand. It is important to note that this is not just so simple, cut and dry. and we need to remain a bit cautious when we're going into what these things can really mean for markets, right? Now, net overall, these are two positive benefits, but the question is whether or not they're going to be enough of a benefit to really drive Bitcoin back above 75K and then drive us up really to six-figure Bitcoin, like $100,000 or more. And I think that there's a chance for that to happen, but if we take a look at the ETF inflows visualized here, we can see that the overall cumulative inflow of ETFs are starting to slow. And that's been mainly due to grayscale offloading positions. Now, once that starts to come to a close and we start to see, for example, to be more particular, it's the Genesis outflows of BTC through GBTC, right? So Genesis has been unloading through its bankruptcy proceeding hundreds of millions of dollars worth of Bitcoin so far. And that's continued to weigh down on those ETF inflows, right? So if we start to see that change, if we can start to get the same kind of expansion we had in the past, then it's business as usual. You're going to likely clear through 75K. You're going to go on to six figures. I think that that's easily possible when you mix in the halving event, where the real net benefit of the halving event starts to go into effect, where the supply increase gets cut in half every single day, right? Instead of about 900 Bitcoin, it's going to drop to 450. And that's a noticeable amount, especially when you pair in increased inflows or demand from the ETF. But so far, we are seeing stagnation here. It is a very clear difference. You can see two very clear trends here where we have started to stall and creep up very slowly. And that is not going to work to the benefit of Bitcoin's price. If this continues to stall or potentially move down, that is going to be a very big warning sign for a more heavier correction to the 100-day or 200-day. Don't be so surprised if we see what we saw back in 2016 and 2017, revisiting those prior highs from back in 2013. History not only has a ability to repeat itself, but outside of that as well, I think we've got the setup here where there could be a post-halving correction. You could also see as well if those ETF inflows don't spike up off of the halving event, then it's just, again, going to feed into this narrative that people get concerned. We're at the previous all-time highs, and we get that correction down towards the lower range. Doesn't mean that the overall rally or the run-up or Bitcoin's ability to go to six figures is completely canceled. I'm not saying that, but I'm saying in the near term we may have something that spooks people. I know a lot of people as well are, again, when it seems like our prior narratives, that everyone's really excited about, like the Bitcoin ETF inflows, the halving event aren't really delivering as much as people expected in regards to price, then the market starts, reaching for straws and trying to go out and talk about other topics. And one of those is how in mainland-based equity funds in China, through Hong Kong subsidiaries, they're now filing with the equivalent of the SEC in Hong Kong for an ability to launch spot Bitcoin ETFs. Now, similar to the United States before its spot Bitcoin ETFs, there was also futures ETFs, and they have those in Hong Kong already. But now, these spot Bitcoin ETFs would add potentially more spot demand for the overall price. Now, this is definitely, it's an exciting story here, and it's something that I definitely, again, as we've seen with the Bitcoin ETF, I think at this point, if you are starting to hear that there are these companies, these large established entities reaching out to the governmental entities in China in order to actually get this approved, there is probably a good chance that something like this could come here. And we understand clearly in the past that there's been definitely interest in China around Bitcoin. So as we get more and more developments around this could very well be the thing that carries us forward for the next bull market. But at the same time, guys, this is just an application here. We need to be a bit cautious on our expectations. And more importantly, wait for price action to reach a critical level and which showcases to us that it's time, to just, again, continue with the trend here, to build into that momentum, to be able to make those really high risk, high reward bets going into the next few months where we could expect a potential top and a reaching of that six-figure valuation. I'm not so much interested in trading Bitcoin directly to those valuations because at that point you're talking about Bitcoin, let's just kind of say here it's $70,000 going to 100,000, right? We're talking less than a 50% move here, right? You're talking about really somewhere around 35-40% ballpark if I don't have my math off. Like that's not very exciting for me at this point. What does excite me is that increased hundreds of billions of dollars of market cap in Bitcoin. And while, yes, the capital is initially flowing to Bitcoin ETFs, the trickle-down effect on altcoins will be real because there are a lot of people, the vast majority of which, who own Bitcoin, who have that Bitcoin liquid and will be able to rotate into altcoins and speculate elsewhere. And that leads me to, again, talking about our narratives that we're watching here in the market. Like Render is at a very nice cool down valuation against Bitcoin. We're yet again coming down to that 100-day moving average. I would bet that you're going to see a tap on that 100-day like we saw back here in January, here in February, here in March. This has historically been a good range where we can start to find support. And it's at a prime time here because this is turning prior resistance in the past into support. So Render needs to be able to do this here. And it's at a nicer valuation than where it was back, basically about a month ago, less than a month ago. It was around $5 billion. Circling market cap, it's now around $3.5 billion. This is a candidate, in my opinion, that could still do, from this point on, easily a 3x or going towards that $10 billion range, right? So this is definitely something that I would say to keep on your radar here on a discount. We also are more particularly exposed to Golem. This is a play that I think is going to outpace Render. It's at a much smaller market cap, so it has better market to scale. We talked about this in our narratives video. We're still holding our position on Golem. So this is one of my few really sizable bets that I have in the market right now. Another one that I'm definitely watching, same point here with the 100-day moving average, is Stacks. Stacks has cooled down a nice amount, came from around 5,800 sats, and it's looking like it's heading straight towards and steadfast towards around 4,300 here on the 100-day moving average. We're going to wait and see how it reacts there. You might even get a chance to get this at the 200-day moving average. Same goes back with Render. If Bitcoin initially leads here and a lot of altcoins start falling behind, you might get a solid long-term retest of the 200-day moving average. We had that back in 2023, right, where altcoins really bled for a couple months. So it is important to keep that in mind here. I'm not just going to go blindly long on altcoins here. Essentially, if I'm seeing that consistently we're not holding on the moving averages, the 21 day is clearly not our friend here so far. So if I'm not seeing the 100-day hold, I would favor short-term exposure to Bitcoin and then rotating those returns once the BTC ratios start to really hold up on the moving averages and formulate a real trend. But again, keep that in mind here. Again, similar scenario to Render. Stacks overall, while it hasn't corrected as much, went from around a $5.4 billion market cap down here to 4.5. So again, valuations are cooling down a little bit, getting a little bit more realistic. And giving us that ability to be able to revisit prior all-time highs, which already gives us a pretty good return, and then go on a couple of multiples, hopefully, by the end of the cycle. Another thing to consider here is meme coins. Meme coins are still the strongest narrative here, guys, in this market. It is the fastest way where you can go from having a small portfolio to be able to have a large portfolio. And whether you or I like that or not, I'm not particularly happy that meme coins are the central narrative of this cycle. I'm here to help you guys as much as possible towards being able to make those kind of multiples. And if you're not able to make them buying the legacy infrastructure plays, for example, I could list a dozen L1 plays out there: Binance Smart Chain, Arbitrum, Optimism, Cardano, XRP, all these different names that are larger by market cap than most plays. I'm not going to be pushing those on you. We're traders here. I want to make sure that you guys can make good returns in this cycle, but also do it in a way where you don't lose your shirt. There's a lot of ways to lose money on meme coins. So we'll continue to talk about them here. We covered some in our narratives video, but the key thing here is just to focus on what sectors are showcasing strength, which individual plays are holding up in their BTC ratios. Sometimes you have to create custom BTC ratios. So for example, I'll show just how you can go about doing this so you guys can utilize it for your own trading activities. Take Pepe, for example. It's one of the larger cap ones. I think Pepe doesn't have a BTC pair. So what I recommend doing is taking the Binance pairing here, Binance Pepe USDT, and you divide it by, in this case, BTC USDT. So essentially the dollar pairing portion of each pair cancels out and you get a nice custom ratio. And what do you know here? So far, even though these had phenomenal performance, Pepe really had a secondary wave here back in February. We can see that it started to fade here. It's starting to kind of flag. This is not a bad set of price action, but right now we're not above the 21 day. So maybe watch for an opportunity to get these names on the 100-day EMA, right? Potentially for a nice bounce and a continuation. And that gives us really nice corrective figures, right? Right now we're already down about 31%. Getting this at a near 50% correction in that pocket would be really great. And that's where you can still have a play like Pepe, possibly do a 2x back to the previous highs. 3, 4, 5x, and these are the large cap meme coins. We're focused on the small mid cap ones, emerging players and emerging sectors of crypto. But again, I want to bring it back here to this topic of the overall altcoin cycle, because while we've got some plays we're watching, we got the narratives, we've got the kind of price levels to watch for, we've got our tools and how to build custom ratios and pairings to see which assets are performing best and make sure we're positioned properly. At the end of the day, guys, right now, we still have not been able to clear through the level we've talked about for the past month and a half. And that is clearing through 13.5% on a weekly close on others dominance, or others.d, right? You can track this on TradingView. It's a public metric that everyone can access to. And for me, this is really critical, because if the others dominance, which tracks all of the other cryptos excluding the top 10, right? These are really this is the best metric we have for the altcoin market and its dominance and share over crypto as a whole. If that can't get cleared, your best bet right now is probably in Bitcoin in the near term, right? Betting on Bitcoin continuing here in the short term, on the increased narratives of potential inflows from Hong Kong, etc., right? That's what the market is pricing in on, right? It doesn't seem to have much of its focus on Ethereum. It has a lot of focus right now on Bitcoin being this kind of central asset. And then there's this kind of ebb and flow where liquidity will start to circulate into Ethereum and a whole range of other altcoins, especially into those other plays, right? That's what I'm watching for here personally. But I want to, again, emphasize one thing as well. There is another thing you guys can use in your arsenal to make sure you're generally hedging your bets. I think one of the important things above all is that if you're looking to really tap into making multiples in the altcoin market, there are obviously the narratives we talked about. There are established players that will still do quite well, but there are also a category of projects, and I would label them as early stage projects, that are going to give you that ability to make those heightened rewards with minimized risk. And that's why I want to spend some time to talk about our partner in this channel, Angelblock. Now, many of you probably already know, I've been an ambassador with Angelblock over the last 2 years. And Angelblock is one of the leading platforms or launch pads for early stage projects in the crypto space. The reason why I want to bring your attention to Angelblock here, and why we also work with them as a project, is because Angelblock itself is the best and most reputable platform when it comes to early stage projects. They are doing extreme vetting on these projects, so you know that you're getting longer term projects. But beyond that, they have all the right systems in place, from on-chain metrics for token economics, investing schedules, all transparent and verifiable. But along with that as well, details on the team, delivery milestones, in which prevent all of the funding from going to the team until they deliver on key milestones. And it allows you to not only have all these checks and balances to be able to make sure that teams don't essentially run away with the money. Essentially, we're preventing a lot of the rug pulls that happen in the crypto space that I think all of us are familiar with at one point or another in our trading experience. But beyond that as well, bringing some really quality projects and ecosystems that are thriving. Solana being one of the big ecosystems that everyone's really juiced up about this cycle. It's been a huge comeback since 2023 and 2024. Well, they have projects like Stable, which is one of the first frictionless cross-chain DeFi hubs for layer ones, which plugs into Solana and a lot of the emerging ecosystems like Sei and Sui. So I think that you guys should really take a look into projects like Stable that launch on the Angelblock platform. This is one that was raised back in 2023. And overall is emerged in one of the biggest and fastest growing ecosystems in the crypto space. We talked about Script Network before as well, but there are going to be a whole range of projects, unfortunately, which I don't know about yet. Some of them I do know about, but I do want to let you guys know it's going to be really exciting roster for Angelblock. So I definitely recommend you guys check out the platform and keep an eye on new projects that are going to be launching. You can also follow them on Twitter as well to get notified of upcoming raises. But the key thing to understand is that the Thol token is at the center of it. By staking Thol, you have an ability to get a larger allocation to some of these earlier rounds, but it's open for anyone to participate as well for a certain amount of ticket size. So definitely consider checking out Angelblock. It's a really cool platform. They're a multi-chain platform for raising capital. So this isn't just focused or pigeonholed on one ecosystem like Ethereum or Solana. They can service a whole range of different networks. Now I want to go ahead here and talk a little bit about the macro, guys. I want to go ahead and step back here because, again, we've talked a lot about the micro. We do believe that there's this ability, and I've even chatted as well with Russ, for example. Russ has been really, kind of keen in this idea of like a Goldilocks scenario where we have this extended window of time of optimism in equities and crypto. And I generally align with him now and stuff, seeing Bitcoin at previous all-time highs, seeing altcoins and the kind of activity we're seeing in Memecoins, the narrative around AI and the productivity boost that's obviously going to start bringing into the economy for a lot of companies and earnings. I do want to mention one thing here, which is that we need to not lose sight. We need to focus on also what's coming over the next couple of months. We can't just be trading in the here and the now, and we've got to make sure we're prepared for what might be coming in the next couple of months. And that's even something as well that the Goldilocks scenario essentially signifies here, that we have a grace period where things are good, things are optimistic. We're tapping into those opportunities, we're tapped into the narratives, we've got our positions, we've been making great returns over the past couple of months, right? We've really come back swinging in 2024. But the big thing I want to make sure we're not, going to get caught in is losing track of the big picture, because we can see very clearly here since back during the summer of 2023, the yield curve has started to uninvert and is forming a very clear wedge pattern, which I would bet money is likely going to break out here sometime going into May, June, or July, as we go halfway into the election season coming up in November 2024. The reason I say this here is because we are seeing a lot of warning signs. We're seeing that yields, when it comes to treasuries, are starting to normalize a bit. This is one example of that, how the yield curve is starting to get back into action. But beyond that, you're also seeing the 2-year, the 10-year, practically all treasury yields in the United States starting to track back up as markets are repricing, both in bonds and in equities, for the amount of cuts that we can expect from the Federal Reserve in order to stimulate markets and ease the economy. There have been a lot of cut expectations for most of this the prior year in 2023. In the first quarter of 2024, that has started to readjust. And I want to bring it over here to talking about equities, because when we really zoom out here, I'm going to bring it here into the 3-month chart. I mean, guys, we're looking back since 1929. Grab a cup of coffee and bear with me here, because I think these kind of charts hold dramatic significance, and they can show us when we're perhaps a little bit overheated, or it can also show us here when serious macro events are about to play out and kind of a counter opinion. And I want to talk a little bit about those here. So when we take a look at this chart, there are a few key observations to be made. Generally speaking, the number goes up and to the right over the long term. It's difficult to bet against that trend as productivity and technology continue to get better over time, and as the world continues to move into a better standard of living decade after decade after decade. But beyond that as well, there are also some very key significant points here. We can see that there are highs and lows, like the 1929 range at the peak of the Roaring 20s that collapsed all the way from 32 points down here towards around 5 points in 1932. And it took from that point on for the stock market 25 years, nearly 25 years here, to get back up towards those prior highs in the past. So that's a significant point here. Now, along with that as well, we can see that there were lows here like 1974, where we had a 50% correction. And it took a long period of time, all the way here until 2000, nearly 70 years later, for us to get towards this upper band of the dot-com bubble. And I think that there is a very important point to be made here, which is that there are these periods of time where we really go through euphoric waves in markets. However, we had a decade of near stagnation as the trend went sideways and had two 45 to 50% corrections following the collapse of the dot-com bubble, which hit tech stocks more particularly, and along with that as well, the broader housing correction we had in 2009. And since then, we've been just continuing to charter up in one of the strongest rallies we've really had since back here between the 80s and the late 90s. The key thing I want to signify though is essentially when we take a look at this chart, right, this has held historic significance. The two prior parabolic highs in equity valuations have demonstrated that this is a point of resistance, and we got clearly shot down here in 2022. Now we're getting very close back up to those levels. Now, I'm not someone who's going to say use this line as a end-all be-all, and when we hit that valuation, equities cannot go higher than that. That would be really close-minded, right? There is an ability for this to go through there, right? But I want to make it very clear here that historically speaking, this is a range of typical resistance. And I'm not here to tell you that like you should go short at that range or sell everything, but watch how valuations react in this range. Don't be so shocked that just because there's AI, because there seems to be what many people believe is infinite liquidity in the system, right? that this won't face resistance here. There is a certain amount of liquidity in the system at any given time, and it hasn't been expanding over the last 4 or 5 months. In fact, it's been pretty much at the same level if you're measuring it by M2 from where we were back in 2021. So we've had a couple years of liquidity stagnation here, and the price premium people are paying here is around the hopes and estimations around AI. It's the reason why NVIDIA is sitting at around a $2 to $2.5 trillion valuation, where it was back a couple, year or two ago, back around a couple $100 billion. So there's been a huge amount of value creation for assets. The question is whether or not it's too separate from reality. And when you look at a lot of big FANG stocks, a lot of big tech companies that are already very large in size, trading at 30, 35, 40p multiples, if not more, you got to ask the question of whether or not we've got that ability to break through a historic trend line that has held since back nearly over 100 years. And this isn't the only chart I'm bringing you guys here today. I'm giving you lots of food for thought. As I mentioned, grab a cup of coffee. We're going to close off on a really interesting note here. We've got a couple interesting charts to dive into. This is another chart that I've probably shared once or twice here in the channel before over the last couple of years. It's something we usually only share with Dash Report members. It's our newsletter here in the channel. But generally speaking, this is a really keen chart that I think you guys should keep an eye on. It's the NASDAQ S&P 500 ratio. And this is another long-term chart here. This is an over 50-year chart of pricing data we have to work with. And I think it tells a very interesting story. It's a story of technological cycles or technological waves. And we can see here how the NASDAQ, which is predominantly exposed to technology stocks, whereas the S&P 500 is just the broad top 500 stocks, what we find is that there are innovative waves where new technology takes off. You take it back here in the 70s, you really start to have a lot of enterprise-ready systems for essentially a lot of the big, basically large corporates in the world. And because of that, there was a whole new wave of technology companies that were providing technological solutions. Think, where kind of crypto feels like it is today is this kind of niche technology. That's where the internet was back then in the 70s and the 80s. That's where a lot of computer systems and hardware solutions were at the time. And of course, we have contractionary periods where a lot of that valuation contracts back, or the S&P 500 plays catch up, right? And I think what you generally see here throughout history is that you have two waves. You have those that are building the solutions for tomorrow and those who essentially benefit from it. The NASDAQ and the S&P 500, right? The NASDAQ is the new wave of technological companies that are building those solutions, and then you start to see that they moderate in their valuations. But along with that as well, the S&P 500 starts to play catch up and actually starts to be the real benefactor of a lot of these things and boosts to productivity and actually being able to materialize on a lot of these new technologies and generally benefiting from the better world and wealthier world that exists at that time. And valuations contract back to the norm. Now again, I want to signify here, the trend is up and to the right long term. Technology prevails, and it is usually the place you want to be exposed to. But what I think this chart tells us here, whether it's the dot-com bubble or whether it's the expansion from 2008 here to 2020, we're seeing a very clear trend here, like we saw back here in the 1980s, where technology stalls and it starts to severely underperform against the S&P 500. Doesn't matter if the market's moving up, or the market's moving down. I'm not here to tell you which direction it's going to go exactly. What I'm here to say, though, is that there's an important point here that you should likely focus on exposing yourself to the top performing asset class, whether you're long-term or short-term. And the important thing that a lot of people are missing now is that even with all of this expansion around the AI narrative, around the optimism of what AI could bring, right? We can see here that the NASDAQ is still struggling to get above its 200 week. It's been struggling to do so since it broke the support back in February 2022. And this is exactly what happened back here during the dot-com bubble, where the 200 weeks started to serve as resistance. It's the exact same thing that happened back here during the 1980s, where for, in this case, a year and a half, the 200-week faced, essentially the NASDAQ to S&P 500 ratio faced resistance on its 200-week and continued to collapse from that point on, from 1986 all the way to 1990. So what's my point in all this here? My point here is not to say that the stock market has to go down. If you look through a lot of these periods in history, for example, during that window in the 80s, right, from around here in 83 or 85, right, generally speaking, the tech stocks still went up. They went 100% up during this period of time. This was, of course, over a pretty long period of time. It was over 8 years. So that's not crazy performance, but that's still generally up. So the market didn't collapse. So I don't mean to tell you that here with this chart. I'm not here to tell you that Nvidia can't climb anymore. I'm not here to say that the FANG stocks can't keep going higher. In a world where there is unlimited money, obviously assets can appreciate. What I'm here to say though is that focusing on the same assets of the last decade as your single point of investment, like just going all in on Bitcoin, just going all in on the FANG stocks, may not be the best investment strategy. And again, I'm just again going to mention them again. If you guys haven't checked out on video on Fridays, Russ's uploads, he did a really great video on silver recently. And I think that that's like a great contrarian piece here where he's finding pockets of value, similar to how we try to do with the kind of altcoin narratives, or also as well in some of the stock sectors we cover within the Dash report that we don't talk so much about here on the channel. I think that that is where you're going to find a lot of the value opportunities. It's where people aren't looking right now and where people aren't totally buzzing about right now. Right? We try to find untapped value in the market. Because if you can find those new market leaders that are going to lead in the event that we are continuing onto a new bull market, in the event maybe as well that we clear through this line of resistance and really go into la land with valuations and money seems abundant and plentiful, then you want to be exposed to the narratives that are going to benefit best from it. And they're not likely going to be large cap stocks that are already multiple trillions of dollars in value. They're going to be in the small caps and mid caps. We can take a look as well here at the Russell to the S&P 500. Again, you tend to find as well that sometimes it can be that the Russell gets to really cheap valuations against the S&P 500 during market peaks like here in the 1990s. But the key thing here I just want to signify is, again, that right now the small caps or the Russell 2000, these are really stocks that are trading at a couple $100 million to $2 billion in value. These stocks are trading at a pretty solid discount, their lowest level against the S&P 500 since 2001, or similar level back here in 1990. So as we get into this pocket here, this is where I'm looking for new leadership. I'm looking for new plays. I'm looking for things that even during a potential bear market or even a period where markets are more neutral or maybe trading higher, plays that are going to extensively outpace the S&P 500, right? Because what I think you see here throughout history is that you go through kind of recessionary periods of time where markets are generally underperforming or it might just be more stalling, and you have small caps that really start to climb the ranks. And then as you're going about halfway through, some of those names become so big that they start to rotate into the S&P 500. There is essentially a rotation of stocks, new names coming in, right? The new FANG stocks that start to arrive and move from, say, the Russell 2000 to the S&P 500, the 500 largest stocks, right? So I share these charts here again just to give you guys some really interesting food for thought. Another one as well is NVIDIA. We've brought up this chart a couple times here. I'm just going to keep bringing it up here, guys. We're up 800% since October 2022 on NVIDIA. It is now up there with Apple and Microsoft to become one of the largest companies in the world. We saw a 1,200% expansion before, a 1,000% expansion, and an 800% one. It's right in alignment with those prior highs. Not saying that we can't have another couple of weeks where this maybe kicks up and has a blow off top. Maybe we really push towards the upper band here. Maybe we see similar price performance to the prior rally. We go up to $1,000, or essentially a 1,000% move, or $1,200, making NVIDIA probably the most valuable company in the world. But that's around the time when reality kicks in, and it's probably time to start taking your chips off the table and leaving the casino. That's the way I would put it, right? That could very well happen. We'll see. But I think we're getting towards the later stages of this, and when I see oil and other energy-based commodities starting to kick back up, I'm reminded here that we are probably very well overdue for a commodity cycle. We're overdue for more conservative, predictable businesses to catch back up to the valuations of their high growth tech counterparts, which are probably not going to be growing as much over the next couple of years. So just keep that in mind, right? Now, above all, guys, I think this just is some food for thought. I don't see many people covering these angles. We're a bit unique like that on this channel, that we cover the macro. We really try to cover as many angles as possible. And I think that above all, if you can understand all that's going on in the world, it can really help you to kind of solidify your investment thesis. And whether or not you agree 100% with my views and stuff, I hope above all, it's some food for thought for you to do your own analysis and make your own decisions when it comes to trading and investing. So above all, guys, I hope you enjoyed this video. If you did, consider dropping a like. It's a great way to support the channel. And if you guys are considering investing into a longer term portfolio, if you believe that, for example, the S&P 500 is going to break through here, the Fed's just going to get wild with printing, and you want to build a stack of Bitcoin, you want to build kind of that long-term, kind of hedging portfolio in cryptocurrencies, I definitely recommend you guys check out Capital. They're our partner here on the channel. I'm going to have a link down below in the description where you guys can get $100 for signing up an IRA account through Capital. Capital is focused on building an individual retirement account, which is a structure in the United States that allows you to either defer taxes or minimize your tax obligations on a retirement investing account. So you can build one where you can buy crypto like Bitcoin, Ethereum, a whole range of other altcoins that you guys know and love already. And along with that as well, you can buy gold and silver in there and essentially be able to build up this hedging portfolio, which will allow you to have a variety of different IRA structures where you can minimize your tax obligations. So I think it's really great. The cool thing about it, above all, one of the greatest features I would say, is even if you're more of an active trader, it can be great because you're not having to file taxes on what goes on in that account every single year, right? So essentially it's a tax-free account wherever you can trade, you can really compound those returns. And what's great is that depending on the IRA structure, there are various different setups where, for example, when you go into retirement, if you don't withdraw the account before retirement, you essentially will pay a much lower tax rate on those returns based off of your income in retirement. If you're not working, that income rate is going to be much lower. So anyways, I definitely recommend you talk to a CPA or tax accountant. But above all, I think that you guys should definitely check out Capital. They've been around for many years. We've worked with them for a long time in this channel. And again, you guys get $100 if you sign up on an account down below in the description. Thanks so much, guys, for tuning in. As always, again, if you enjoyed this video, consider dropping a like. And hope you guys have a fantastic rest of your week. I'll see you guys right back here on Monday. Take care, everyone.